How you doing, everybody? Been recording quite a few videos recently that are a little more consumer friendly, going over the difference between maybe a bank, a banker, or a mortgage lender, and then a broker. This spawned from the hashtag brokers are better, which gets a lot of press, but it also depends heavily on who you work with. I ask a lot of questions to a lot of loan officers out there. And, one of the main purposes for this video specifically is I'm doing it more LO centric or directed towards loan officers because your culture really depends on, or the information that you believe really depends on where you get it from. In other words, if you watch nothing but CNBC, you're probably going to have only a certain part of the story, rather than if you watch Fox News, you're also going to have a certain part of the story. So if you're working for a bank right now, you probably know all the great things that a bank can do. If you're working for a mortgage lender, you probably know all the great things a mortgage lender can do. And if you're working for a broker, you probably are very great things about a broker that you work there for. So I just wanted to get into the nitty gritty, kind of define all three of those LO wise and what it means to you as a loan officer. I've had the benefit, or I don't necessarily want to say benefit, but benefit for this video to have worked in all three of these in the last 4-year period. So I just kind of wanted to bring a little up-to-date comparison on the top 5 things that I think really makes loan officers' decision as to where they take their business, where they go, all of the above there. So I call it the 5 Ps. It makes it very easy to remember this. Let's start with the first P. We're talking about products. Now, obviously, if you work for a bank, we're not going to go with, credit cards and checking accounts and all that stuff. We're talking just mortgage products. When I'm talking about mortgage products, I mean, you have all your agency stuff, all your Govy stuff. So FHA, USDA. Then on top of that, you have first-time home buyer programs. Then on top of that, you have Alt-A. Or, these are your bank statement programs and, the ones that get a little more creative. Now, a bank, pretty much nothing creative. I mean, all of their creativity is out the window with the exception of portfolio products, meaning they're products that they put together in-house. Now, one of the things about a bank, and we'll get to that part in another P, a mortgage lender. Now, they do have most of the time all the agency products and all the Govy products, as long as they've gotten the right credentials. Their underwriting, they get delegated to do all of these different loans in their name and close them in their name. And then they have non-delegated options for a lot of Alt-A, meaning they don't really have their own underwriters underwrite this. They push it off to somebody else. It's kind of like a broker submission, but at a higher price point because now it's a lender and, you have to work in all of their payroll fees and all of that stuff to meet the guidelines of what they're looking for in a profit center. So mortgage lender has more than a bank. Now broker pretty much is the winner in products because if it's out there, they can get it. And there's not a lot of reason not to. See, a broker never underwrites anything. So they're basically tapping into the underwriting of whatever company there is. So if there's a niche that we don't fill as a broker in, 80, 90 different lenders, and one of them has it out there, as long as they don't have some sort of major penalty of doing business, then most likely a broker is going to get them aboard. So I would say with products, you're definitely going to win with a broker just because they have such a variety of them that it's very hard to lose a loan to not having the product to accommodate the client. The next one is price. Now, there's some variables in price that should be discussed. At a bank, truth be told, most banks operate at a loss. Most banks' mortgage division doesn't make money. They make their money in the checking savings, this, that, and the other. And because they have a footprint in the state where they have a brick and mortar location, they are mandated to lend And given that they've never really had a super strong mortgage originating team, their lending is a little weaker than normal. So to meet those minimum quotas, they take a loss. So their mortgage divisions are most of the time, and I'm not saying 100% of the time, but most of the time banks, it's not their profit division. So their rates are higher. And when I say price, I mean the price to the consumer. You know, how many basis points are worked into that delivery to the consumer for the survivorship of the entity. So bank, you're going to have a pretty high price point to the consumer because they are very large entities. They have a ton of rear ends in a lot of chairs that they have to pay for. They're also heavily weighted in salary, insurance, all that stuff, which is a huge cost for any kind of business. So, and then once you get that size, it's even more of a cost. Let's talk about mortgage lender. You have less of a cost than a bank. So their price point is typically better than a bank is. Mortgage lenders typically work between, and I'm going off of a variety, but mortgage lenders typically work off of about 400 basis points to a consumer on conventional products and about 500 on Govy products. So all your FHA, VA, and USDA is typically delivered about 500 basis points charged to the consumer. And the other conventional stuff is about 400. Now, out of that charge to the consumer, of course, they deliver your compensation. They also pay for processing, underwriting, docs, funding, setup, disclosures, all of those rear ends in the seats and their insurance and their salaries, because those people are not bringing in loans in the door that gain profit. Broker doesn't have underwriters. Broker doesn't have processors, docs, funding. They're using the lenders, underwriters, processors, docs, funding, and the lender is basically giving a broker a discount, and the top broker charge is 275 basis points. So if you're comparing a conventional loan to a mortgage lender, the charge to the consumer is going to be about 125 basis points less. And the easiest way to equate that is think about the rate that you're giving today. Without any charge, you would be giving them 1.25 credit towards closing costs, or you would be giving them a substantially lower rate. That rate is probably 3/8 to 0.5 point lower to rate going with a broker. That's because the charge to the consumer is capped across the board at 275 basis points. So by all means, you're going to get the best rate or best charge to the consumer at a broker in comparison to a mortgage lender or a bank. Now, truth be told, profitability in all of those, bank works at a loss and they have the highest charge. Mortgage lender, typically, and when I say mortgage lender, I mean, their profit once everybody is paid. I would say it's probably between 25 and 35 basis points. Most mortgage lenders, once all the dust settles and they're actually talking about profitability. It's not much different with brokers. All right. Brokers take a little smaller piece of the pie because the charge is a smaller piece of the pie. And since they don't have all of the extras, but they clear anywhere from 25 to 35 basis points, the owner of the broker. And when I say that, it basically means the charge to the consumer is less, which means the interest rate's less, but the profitability is very similar from one to the other. Let's talk about another P, pay. When I say pay, I'm referring to compensation. Loan officer compensation. Now, this is a huge moving target. I happen to be in Arizona. I think Arizona and Nevada are the two highest states in LO compensation average. And I think our states probably average around 170 basis points to the loan officer. I've seen as high as 250 at a mortgage lender. And I've seen as low as 125 at a mortgage lender here in Arizona. The average nationally is about 97 basis points. So if you're on the East Coast, a lot of people make about a point on the East Coast. Now, a lot of this has to do with whether you're getting leads, whether you're not, blah, 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 blah. But I would say when it comes down to compensation, it comes down to what are you getting paid? Are they providing the lead for you? and what's the charge to the consumer, because those two work hand in hand. Price point to the consumer and how much is yours versus how much is theirs. So looking at compensation, and I can only speak for the broker that I'm at currently, Nexa Mortgage. I typically average anywhere from 198 to 220 basis points on a charge to the consumer of 275. Now, I have fees and all that stuff that I have to pay for out of those 220 basis points, but the bottom line is Nexa, or the company that I work for, only takes 55 of the 275. A mortgage lender that charges, say, 400 on that same loan, I don't know too many places that pay 220 basis points, at least on a charge a consumer of 400. I have seen some that allow you to charge more and you get paid more, but the company needs that extra wiggle room to actually pay payroll, so once you start getting into too low of a charge to the consumer, you can no longer perform because you can't pay the people to move the loans through the system. That's the challenge to the mortgage lender. And then of course, bank is not even on the map here, and honestly, bank is really not on the map of any of these, with the exception of maybe if you're new, or if you need a salary, or if you don't have a mortgage license. If you can't pass the test, then that would be a good reason to go to the bank. All right. Let's talk about another. So pay, I would definitely give the edge to the broker. Once again, I've seen the most aggressive pay models, especially when you compare it to the charge to the consumer. Once you start getting leads, it really doesn't matter who you're with, broker, banker, they're going to pay you less anyway. I'm talking about on your own clients, you're probably going to make more with a broker and charge that consumer less, even for more pay. Let's talk about another P. We're talking about performance or production. When I say production, I mean fulfillment, production center. How is your loan moving through the system? When it comes to a bank, this is probably the worst. Well, when I say the worst, I mean in a comparison of totality, everybody. There are exceptions to every rule when I say this, but banks typically operate the slowest and they have the least communication between departments. Mortgage lenders are much better. Sometimes they put you in a team, and the strength to a mortgage lender is it's a rinse and repeat process because they keep it in-house. So it's kind of like nothing really gets out of hand unless it's a non-delegated deal and you have to send it out to another underwriter. So your expectations of kind of what to expect from the same team over and over again, you at least get the ability to get better and improve upon the process because it's an in-house situation. So, that production I've seen horrible and I've seen really good in my experience working with a mortgage lender. It really depends on the people that work for the mortgage lender. And that's the separation, is if you're with a good group of people, it's great. If you're with a bad group of people, it's horrible because you're stuck with them and you can't do anything about it. Broker, this can be either a train wreck or this can be great. Now, when I say great, obviously, just like there's certain groups of mortgage lenders that have good people, there are also lenders, wholesale lenders, that have great people that work for them. The bottom line is with a broker, I have, 80, 90 or more places to send a loan. So where I send it really has a lot to do with, the price to the consumer, how competitive that rate is. But then on top of that, how fast and easy can I move this through their system? Fast and easy depends on the team. How much predictability is there? Are they going to drag this out? Are they going to miss conditions? Are they going to make mistakes? All the mistakes cost money, time, reputation. All right. And those are three things that I don't typically like to sacrifice. Now, there is one company in particular with a broker that is so technologically advantaged over every other company. And I won't mention the company. They know who they are, and you guys probably know who they are. They probably get 1 out of 3 wholesale loans. But when you think about it, 4 out of 5 loans in 2020 were closed by mortgage lenders or banks. So 1 out of 5 were closed by brokers. So when it comes to a production or performance from a company, it really comes down to that lender and the people that are in that group with that particular lender. Now, if you happen to work for that lender, then you might be in a good situation. But the bottom line is I have a lender where I'm closing on an average 7 or 10 days, clear to close. It doesn't matter if it's purchase, refi, they're that fast and their conditions are that clear. And because most everything is automated, it clears very fast. If something does come up, I'm not saying they're mistake-free because they do make mistakes. It's just how fast we fix that mistake. It's almost like nobody even knows it happened in comparison. So once again, I'm going to give the edge to the broker in the production and performance with a slight caveat that if you have DPA business, down payment assistance programs, and you're heavy with these, mortgage lender is probably a better place for you. If that's 80% of your business, there's a lot more predictability when you have the same underwriting teams and this and that and the other on those types of loans. When you're dealing with 5 different lenders, 6 different lenders, yeah, you're going to run into hills and valleys, but you're probably going to deliver a better price to the consumer at the broker. It's just predictability. You're going to be better off with a mortgage lender on down payment assistance programs. And the last P is people. You know, we're talking about culture here. You know, what kind of company do you work for? Me, myself, you know, and I make no mistake about this. When I choose to go work for a company, even though that's not my company, I'm hiring them far more than they're hiring me. And when I say that, you know, I'm a loan officer that brings my own clients to the table. I don't take leads from somebody and, you know, close their loans for them. And if that was the case, maybe they would be hiring me a little more. But if it's my clients, my marketing, my background, my this, my that, I'm giving the lender or the broker or the bank a piece of my action. You know, they're not really providing me anything with anything other than the umbrella to close them under and taking a piece of the business. So people in culture is a big deal as to who I work for, you know, and obviously if they have a culture of, you know, gouging people or, you know, they're not diverse. I like a diverse culture because, you know, I don't do loans for just Republicans. I don't do loans for just Democrats. I don't do loans for just whites or blacks or Hispanics. I like some diversity in the culture. So, you know, it offers a little more of a wider footprint in my marketing aspect. I also like hearing background or feedback from different cultures. I like having a little more empathy to different cultures since I may not have one other than my own, you know. So offering that for a company who offers that is very important to me. You know, and when you really look at culture and diversity, most of the time for a company to really offer a good amount of that, they've got to be a pretty decent sized company. Banks are huge. They're probably going to offer a wide variety of diversity and culture. Mortgage lenders can get pretty huge. I know of, you know, a small handful that are, you know, well over 2,000, 3,000 employees. So they can get very large. And the culture's also very diverse. I've seen it, you know, in 3 or 4 that I've actually worked for. So nothing wrong with culture there. Brokers are typically small. All right. This is one of the areas that I would probably give the advantage a little more towards bankers and or banks and mortgage lenders because of sheer size. Now, truth, the company I work for is huge for a broker. As a matter of fact, I think they're the biggest broker in the United States as far as the size of loan officers and the amount of loans they do. I think we have like over 1,400 loan officers right now as a broker, which is enormous as a broker. But that size really does lend towards the credibility or the influence of the culture. And you really see this in the annual events when everybody kind of congregates into one area and you see a lot of faces that, you know, you may have heard in a meeting or something like that. A lot of ideas are across the map. It's a great thing. So going over the 5 Ps, products, I'm going to give the edge to the broker. Price, once again, edge to the broker. Pay, once again, edge to the broker. Production performance, I'm going to go broker with the caveat of DPA business being stronger at a mortgage lender, maybe even a bank. It's going to be slower at a bank than a mortgage lender. And then people culture, depending on the sheer size. If it's a broker, I'm not saying that a 25-person shop isn't diverse. I'm saying that, 4 people's opinion is not as impactful as 400 or 40. And when it comes down to that, that's really what separates it, is the sheer size of the companies these days and how much different opinions you can actually learn from, because most of the time your clientele is a pretty wide canvas of clientele. So I really hope this helps. Feel free to reach out to me anytime. I'll have the contact information right outside of this video. If I can help you out with any other things, you can probably see some other videos. Like and share if you'd like.